Ever wondered what the difference between internal and external audits is when it comes to IT auditing? Well, you're about to find out. In the vast universe of auditing, two terms often collide: internal audit and external audit. These terms denote different perspectives and methodologies in assessing the efficiency and effectiveness of an organization's internal controls. In the realm of IT auditing, grasping the distinction between internal and external audits is vital. So, let's embark on a journey into these concepts and discover what sets them apart. Picture this: internal audit as the independent, objective assurance and consultation activities carried out by an organization's own internal audit department. This in-house team is tasked with evaluating and enhancing the effectiveness of risk management, control, and governance processes. Composed of professionals employed by the organization, the internal audit team is steeped in the company's operations, culture, and systems. Now, imagine external audit as a task performed by separate auditing firms, unaffiliated with the organization under audit. These independent entities are commissioned to provide an unbiased assessment of an organization's financial statements, internal controls, and compliance with relevant laws and regulations. The spotlight for external auditors is on delivering an opinion on the fairness and reliability of the financial statements as a whole. Let's now turn our attention to IT auditing. IT auditing involves scrutinizing an organization's information systems, data integrity, security controls, and IT operations. It ensures that an organization's IT infrastructure is appropriately designed, implemented, and maintained to buttress its business objectives and safeguard its valuable assets. Both internal and external audits have roles to play in evaluating the effectiveness of IT controls. So what are the key differences? Firstly, consider the reporting line. Internal audit reports directly to the organization's top brass and board of directors, offering internal stakeholders insightful recommendations and insights to enhance internal controls and risk management practices. External audit, however, corresponds with external stakeholders, such as shareholders, creditors, and regulatory bodies. Its primary purpose is to deliver an independent and objective opinion on the organization's financial statements. Secondly, the scope of work. Internal audit has a wider reach, potentially covering various aspects of the organization's operations, including financial, operational, and compliance audits. It can assess the design and implementation of IT controls, identifying areas ripe for improvement. External audit, however, has its sights set mainly on financial audits and verifying the accuracy of financial statements. While IT controls may be evaluated during an external audit, it's not the primary goal. Thirdly, consider independence. Internal auditors are part of the organization and have a vested interest in enhancing internal controls. However, they are expected to uphold independence and objectivity in their assessments. External auditors, however, are entirely independent of the organization and have no personal or professional ties that could jeopardize their objectivity. Lastly, frequency. Internal audits usually take place regularly, such as quarterly or annually, to provide ongoing assurance to the organization's management. External audits, on the other hand, are typically conducted once a year, in line with regulatory requirements or whenever necessary. So there you have it, a comparison and contrast of internal and external audits in the context of IT auditing. A tale of perspectives, methodologies, and objectives. A story of how two different approaches work together to ensure the integrity and effectiveness of an organization's IT controls.